Hey, what's going on, everyone? Welcome back to K.AshCapital. I'm going to have to switch it up a little bit on this little series due to the limitations of the on-demand feature in Thinkorswim. I thought I'd be able to place it, then we could write it out to see if it works or see how a diagonal call spread will work in a real trade, but that is not the case. Whenever you place the trade, you don't see the risk graph, you don't really see how it works. So the way to compensate for that is we'll go ahead and scan and find a real play that you can do a diagonal call spread on. And then from that point, I could show you how it works, how the different scenarios could play out using a diagonal call spread, because you can do them in tons of different ways. But that being said, don't forget to subscribe, like, comment. Let me know if you've ever traded a diagonal call spread before and what you think of them. And yeah, let's get it. All right, what is a D-call? Diagonal call spread is where you purchase a longer dated, in the money or at the money call option, and then you sell a shorter term out of the money option against it to bring your cost average down. And all that will make sense in a minute whenever I pull up the trading system, so we could discuss it a little bit more in depth and you can see a visual of what it means. But the pros of it all, pros of a diagonal call spread is puts Theta in your favor for a short time frame, so you can take advantage of that quick Theta decay in the last 2 weeks. If the short option expires worthless, or if it's closed for a small profit, then you can still hold on to that long call to catch the bigger move to obtain a bigger profit potential. And the cons is if the stock breaks out and surges past your short strike, then typically your profit is capped at the top, because now that short option is starting to go in the money and now it is capping your gains. Once again, all that will make sense here in a second, and now let me pull up my trading platform. Alright, before we set up a combo, first we need to find a stock that we're going to trade, right? So I use FinViz a lot of times to scan, so we come over here to the scanner, set up your parameters. I want the price above the 20 SMA, price above 20. Moving average, I want the price above the 50. Average volume at least over 1 million. And we want it optionable. And that gives us 510 tickers to look at. Well, let's choose it. I'm gonna look for an ascending triangle. Alright, 30. That's a little better. Let's go to charts. Now we want to look for something. We put a diagonal call spread, and what we want it to look like is somewhat like a bull flag, or a bull flag that is consolidating. Because if you did a diagonal call spread on that breakout that's on the Starbucks example, it's going to shoot right past your short strike, and then sure, you'll have a winner, but your profits are capped. And so I want to show y'all the best way to have a diagonal call spread put on. It's not the only way, but it's one of the best ways to get the most bang for your buck. So AMAT looks good, so we could sell probably the 62 or 63 call against a 60 call to take advantage of the sideways movement before it goes up. Or let's see here if there's any other ones. Well, look at that. Lockheed Martin. What formation is that? That is my question to you guys. What formation is that? If you don't know, check out this video right here. Here, it should be popping up on the right side of your screen right now. That has a bull flag textbook, just like what we discussed earlier in the other video. So that is a bull call, or not a bull call, sorry, but a bull flag. Easiest to set up. Alright, we'll look at Lockheed Martin and AMAT as our examples. So stand by 1 second. Alright, so here's AMAT in the charting system. Oh, sorry, that's not AMAT. That's AMAT. clear this up a little bit. Boom. All right. So we can see that it's in a strong trend upwards. It's going up. You can see that it's hitting the $62 level and just consolidating. So it is kind of in a small ascending triangle type of formation. So basically, what you can do to get the most bang for your buck as far as a diagonal call spread goes on this, you want to sell, like I said, a short term out of the money and buy a longer term. So let's do that with this one. This is what we'll do. So let's go to our platform. Okay, so we'll go 10 days out, and we want to buy one that's approximately 30 days out, and the delta is 50 to 70-ish. 61 works. So here's our longer dated call option. So because we're buying the February expiration, and we can get it for about 225. That's a type, or sorry, 360, 370. That's a type bid ask. So you can get that. So as you can see right here, we're buying it for 370. Now this is what I'm talking about when it decreases your cost average. First, we need a target. So it may consolidate a little bit longer underneath 63, but we can call it 64 just to be sure to get a little bit more profit if it does break out. So 64. Here's the 64, 64 called. So we could sell that for approximately 40. So that is, so we're buying it for 370 and selling this one for 340. And let me put them together so you can see what this means. I'll put it all together. Boom. So your total will be 325. So this one big green block right here is essentially these two positions put together. So it's the exact same thing. Now, when it comes to the risk graph, this is what it looks like. Now, how do you read a risk graph if you haven't seen this before? Right here on the left, this is your profit and loss. So anything above 0 is profit, anything below is a loss. This line right here is 0, and then we will make this as if we buy one position. So it's $3.25, so it's going to cost us $325 for one position. Alright, so if you look right here in the bottom of your screen, I'll circle it. And where it says 125, that is your max loss expiration. And then where it says 114, which would be January 14th, is your max loss. If we move it up, you see how our profit and loss on the left of the screen, like keep looking at that box, it changes as we move. I didn't say this part is the stock price. This bottom left part is the stock price. So say it, and it goes to 64 like our target. At the short option expiration, our profit would be $127. And then as you keep going, you see our profit doesn't go up. Even though the stock's still going up, our profit stays the same because of that short strike. Now, say on January 24th, the stock's at $63 and we kept that 40 cents. Now, our risk graph is going to look like this, except this would only be $325 because we got it at a cheaper price. And now, if you look, we have unlimited profit potential as it goes across. So that is the best way how those work. So just to recap. Recap. We chose our entry. We have the setup where it's consolidating, where we think it's going to go sideways to up. We sold the 64 option against it, which gave us 40 cents. Which gave us 40 cents. And then we bought the long one for 370, coming to an average of 325. So what's the benefit of selling it besides bringing down your cost average? It also brings your break even closer. So when you look at the long call at 370, you see our break even at expiration is at 63.71, and the stock is currently at 62.43. So it has to go a little over $1 in order for it to be break even. Now, you sold that call against it, it brings your break even to right here. These red lines are break even. So now if the stock was to even stay exactly where it's at, you are at break even, and that's okay. But if it continues up, then you obviously can't. Now, what if we decided, here's another thing about diagonals, what if we decided to sell the 63 just a little closer? Now our max profit went down, but look, even if the stock goes down a little bit, our break even is now below us. So now if the stock stays where it is or goes up a little bit, we make money. And for the 63 call, you bring in 66 cents instead of the 40 cents from the 64 call. That may seem a little confusing, but basically what you're doing is you're buying one and you're selling another one against them to collect money for it, so therefore it makes your cost average less. And then with each cost average that you change, it changes your profitability and probability. So right here, it's like, say we sold the 63, your probability of making money goes up quite a bit because now your break even is even behind you. So you can stay exactly where it's at and you make a little bit of money. But since we made a higher probability trade, your max profit decreases. So that is how all that sums up. It's a balance between profitability and probability. If you want a higher probability trade, you're going to have less profitability. But if you want a higher profitability in a trade, then you have less probability. If that makes sense. I know that can sound a little crazy when I say it out loud. And it's the same concept with this 63 call. Say it expired worthless. So you kept those 66 cents, and so now you're owning the long call for $2.97, like it says down there. And so now it expired worthless, and now you have so much more upside versus it not. So it's basically like getting a long call for a discount, or it's equivalent to, I know some people do this instead of collecting dividends, because you can control the dividends if you do it this way, essentially. Okay, after recording all that, I just thought of a better way to explain it. So we have sold the 64 right there, and we bought the 60. So basically, what we want the stock to do ideally, like I said, we sold the 64 call for 39 cents. So if the stock goes up and just stays down right here and expires below 64, then we lock in that 39 cents. Now we have just a long 60 call, and then say it breaks out. So now we can collect that entire profit zone as it continues higher. Now if it but say before expiration it breaks out, remember that risk graph that looks like this, then our profits are capped because it stops right there and it goes this way, because at that point, the short call option becomes in the money. Thank you for watching. If you have any questions, please write them in the comment section. I'll answer them to the best of my ability if that video made no sense. I know the profitability versus probability might confuse some people. There are tons of videos on YouTube and a bunch of open source resources for you to learn how to use the diagonal call spread, and there's tons of ways to use them. If you have more time on your hands, go ahead and check out these other videos. Let me know what you think. Go ahead and subscribe again, please. And if you have any suggestions on what else I should make, by all means, please let me know. Other than that, take care.